Oil prices, bond yields, and central bank signals are all moving at once, and the thread connecting them runs straight through the Middle East. Tensions between the United States and Iran are back in focus this week, and energy markets are feeling it first. That is almost always how it works. When conflict risk rises in the Middle East, oil prices tend to climb on fears that supply could be disrupted. That might sound like a story for commodities traders, but the effects spread quickly because when oil gets more expensive, inflation tends to follow. And that puts central banks in a difficult spot. The Federal Reserve has spent the better part of 2 years trying to pull inflation back toward its 2% target. A sustained rise in oil prices, driven by geopolitical tension rather than stronger demand, can slow that progress. It gives Fed officials reason to hold interest rates higher for longer, even if the broader economy is losing steam. Markets are watching every public statement from Fed policymakers right now, looking for any shift in language that might signal where rates are headed next. The challenge does not stop there. Analysts are pointing to a widening gap between the world's major central banks. The Fed is still deciding its next move, but other large economies are at very different points in their own cycles. Some central banks have already started cutting rates, others are still raising them. That divergence matters because it moves currencies, shifts capital flows across borders, and changes which markets look attractive to global investors. The overall picture is unusually complicated right now. For investors trying to make sense of all this, a few relationships are worth keeping in mind. Higher oil prices tend to push inflation up, which can push rate cuts further into the future. Higher for longer interest rates tend to weigh on stock valuations and drive bond yields higher. And when geopolitical uncertainty rises, the US dollar often strengthens as investors look for safety, which creates pressure for emerging market economies carrying large amounts of dollar-denominated debt, meaning debt they owe in dollars rather than their own currency. None of these effects are automatic. Markets can move in unexpected directions, and the situation remains fluid. What is clear is that the combination of Middle East risk, an uncertain Fed timeline, and diverging central bank policy gives global markets more to process than usual in the weeks ahead. The most important variable to track right now is oil. How prices respond to further developments in US-Iran relations will shape inflation expectations, and from there, shape what central banks around the world decide to do next. Watch the energy market, and you will have a head start on the rest. This briefing is brought to you by First Financial News, clear, daily coverage of the economy and markets at firstfinancialnews.com.